Hi there, and welcome to my YouTube channel. I'm Danny Yale. I'm a loan officer in El Paso, Texas with People's Mortgage, and I serve not just El Paso, but also the Las Cruces, New Mexico area. And today we're going to be going over 20 questions for a Texas and New Mexico loan officer. So these are questions that I get from borrowers on a regular basis, so I thought I'd make a video to be a resource that you guys can refer to as you're going through the home buying process. So if you guys find value in this video, please give it a like, subscribe, feel free to share with friends or family, and don't ever hesitate to reach out with more questions that you might have for me. So let's dive right in. First question, how do I qualify for a loan? Well, great question. I'm gonna go through 20 more questions to give you guys some more information about how you qualify, what some different factors are in getting a mortgage and buying a house in general. So be sure to pay attention, and if I don't go over something that you want to hear, like I said, reach out, let me know, leave a comment on maybe what the next video should be. So one question I get asked a lot is, how many years do I have to work at this job in order to qualify for a loan? So I think there's a common misconception that you have to have worked at the same job for a number of years in order to qualify for a mortgage, and that's not true. You do have to have 2 years of employment in order to qualify for a mortgage, but that employment can take place at different employers over the course of 2 years. So that's the first question. Next question is, what are the minimum down payments by loan type and borrower type? That's more so a question that I wrote. Probably a question that you would ask would be, what's my minimum down payment? And the answer to that is, it depends on your situation. There are different loans that exist, and so I've got options to provide to my clients that might be no down payment or minimal down payment, or my clients might choose to put a larger down payment because of the advantages that can provide. So we're going to put a graphic up on the screen somewhere around here, and you'll see that a first-time home buyer that qualifies for a conventional mortgage can use a 3% down payment. Somebody who qualifies for a VA loan qualifies for 0% down. If you're using an FHA loan, the minimum down payment is 3.5%. And if you're buying a home and it's not the first time you bought a home, you'll want to put down 5% if you're looking to put down the minimum. There are also loans, if you're buying, let's say, a vacation home, that would require a 10% down payment. And if you're buying an investment property, the minimum down payment is 15%. There are other loan types that aren't used as often, and those might require 20% down payment. Those would be specialty loans that certain kinds of investors might use, or potentially self-employed people that need to qualify in a different way. And there is also a USDA loan. We've got some USDA eligible areas in the Las Cruces and El Paso areas, and you can use 0% down payment for those types of loans. So the next question is, what criteria is going to be considered when I'm trying to qualify for a loan? Or in other words, how do you determine what I qualify for as far as a purchase price and a mortgage? And that's a really good question, and the answer is there are a number of different things we look at. Number one is we're going to look at your credit score, and that determines what kind of loan you can get and what kind of a down payment you can use. So after we look at your after we look at your credit score and determine what kind of loan we can fit you into, we're then going to look at your income as well as your monthly debts. So these debts, we're looking at credit card payments, auto loans, student loans, any other mortgages you might have. We're not looking at things that don't show up on your credit report usually, so water bill, electric bill, TV, internet, not those kinds of bills, but the ones that do report into the credit bureaus are what we have to consider. And we use those to calculate what's called your debt to income ratio. So depending on the loan type that you qualify for and your debt to income ratio, that's how we can land on your down payment. And from there we start to work with the numbers and figure out where you fall as far as how much money you can borrow and how much house you can buy. So another question I get a lot of the time is, I've got really bad credit. How can I buy a house? And that's kind of a tough question to answer because bad is a relative term. So for some people, having 650 as a credit score is bad. For other people, having 700 as a credit score is bad. So the more information that you can give me about your credit, the better, because I can typically coach you through how to get your credit score up so that we can get you into a place that you can qualify for a loan. So, if you don't know very much about your credit, that's okay. When you have a conversation with me, I'm happy to give you some ballpark estimates, and also we can go through some real numbers if you're willing to let me take your loan application and pull your credit, which is really where I can start to give you that value by telling you if you do X, Y, and Z, we can qualify you for a loan in this many number of months. So the more that you work with me and divulge this information, the better off we'll be working together. So, leading into this next question is, what does a credit score impact when I'm buying a home? And I've already touched on it a little bit, but your credit score is going to determine the loan type that you might qualify for. And so the loan type will determine what your minimum down payment can be. Your credit score is also going to impact your monthly payment because we assign your interest rate based on what your credit score is. So the lower your credit score, the higher the interest rate, and therefore the higher the monthly payment. Okay, I get this question a lot. What about down payment assistance? And a lot of people don't really know what down payment assistance is. I didn't know about it until I got into the mortgage business. So down payment assistance is a short-term benefit for a long-term cost. And to explain that a little bit more, down payment assistance is where you take money from somebody who's offering it to you, and they help you make a down payment on a home. But when you take that money, you then also sign up to follow their rules. So oftentimes down payment assistance comes with a higher interest rate. It might limit the purchasing power that you would have, or the purchase price that you can make for a home. And there are also other rules that come along as well, like you have to live in the home for a certain number of years, and you can't refinance out of that down payment assistance loan for a certain number of years. Otherwise, you have to pay back a portion of that money. So down payment assistance is a great tool for those people who need it, but it's not necessarily free money, because you do end up paying for it in the long run. Recently I've been getting asked, is now a good time to buy a home? And if you ask me, I think it's a great time to buy a home. We've definitely seen a huge demand in the home buying market over the past 2 years. Really, since COVID took off, everybody wanted to go buy a new home because interest rates were super low. Now interest rates have almost doubled in the past 6 months, and a lot of people have taken a step back. They're no longer interested in buying a house because it's not as affordable as it used to be. And so people who are selling homes are starting to see there's not as much demand. I can't list my house on a Friday and have a contract for it on Sunday. And so if you're in the market to buy a house right now, you have the ability to go and try to negotiate with the seller, try to get maybe a better purchase price, or have them contribute to your closing costs. Things that make the deal a little bit more in your favor that haven't been happening very much over the past 2 years. We're starting to see those negotiations come back into play. So again, I think it's a fantastic time to buy a house. And if you want to know more information about that, feel free to give me a call or shoot me an email, and we can have a conversation. Another great reason why now is a good time to buy a house is because you're buying an asset that is very likely to appreciate over time. It's almost certain that the house you buy today will be worth more in a year. So you might be, a little bit scared though that you're getting a high interest rate in comparison to what we've seen the past 2 years. And you are. I just said that interest rates have nearly doubled in the past 6 months. But the really good thing is that you are not married to that interest rate. You can do something called a refinance, where you pay off your existing mortgage by taking out a new mortgage. And when you take out that new mortgage, you can get the current market rate for a new interest rate. So there have been some articles circulating, and I'll put a link to this article I'm referencing in this video. But there's an expectation that in the next 6 to 12 months, interest rates will drop back down into the mid to low 4s. And that's really going to help affordability. However, that's also going to drive demand up. And so I think now is a perfect time to buy a house if you're in the market, because you can do things like negotiate with the seller and try to get a better deal. And then in 6 to 12 months, if and when interest rates do drop, you can do a refinance and get a better interest rate on that house that has already started to gain value for you. So again, it's a little bit of a complex topic, but I'm here to have a conversation and walk you through that process and show you what it looks like to buy a house today and what it might look like to refinance a house if rates drop down to what we think they will come this time next year. Another common question that I get is, what is private mortgage insurance? So it's commonly referred to as PMI, and private mortgage insurance is insurance for your lender that says if you default on your mortgage, meaning you don't make your mortgage payment and your lender has to foreclose on your home, this insurance policy that you as the homeowner pay for will cover some of that lost revenue for the lender. So PMI is something that you as a homeowner have to have on a mortgage if you don't have at least 20% equity in your home. So if you do put down the minimum down payment, you will have private mortgage insurance. It is something that people usually pay on a monthly basis. However, if you wanted to, you could pay more at closing and pay that private mortgage insurance in an upfront lump sum to make your monthly payment cheaper. So this question, the last topic leads right into this question, which is, can I get rid of my private mortgage insurance? And the answer is yes. So let's say you buy a house today, September 1st, and in 3 years you have paid your mortgage down and the market has appreciated so much that you now have 20% equity in your home. You can ask your lender to remove your PMI, and they'll either send out somebody to do an appraisal or something called a broker's pricing opinion, but basically they're gonna assess the value of your home and say, okay, you have enough equity or your loan to value is low enough that we can remove this private mortgage insurance and decrease your monthly payment moving forward. So naturally, you guys might be asking yourselves, like, what can I do to avoid paying PMI altogether? I really don't want to handle this private mortgage insurance that doesn't benefit me at all. And so to avoid PMI, you can put 20% down when you go to buy your home, at least 20% down. Or like I mentioned previously, you can buy out the PMI with a lump sum at closing, which is a little bit more cost effective if you want to put the minimum down payment or less than 20% down. Buying out the PMI is a good option to consider. All right, so now I want to talk about a different topic which sounds really similar. However, it's not. It's called upfront mortgage insurance. And this is specific to FHA loans only. So FHA loans are a great product to allow you to go buy a house, but it does come with a little bit of a downside. Whenever you use an FHA loan to buy a house, you pay upfront mortgage insurance of 1.75%. So this amount gets added to your loan amount, and that means that whenever you go to sell your house or if you want to refinance it, you do have to pay this 1.75% off in addition to the remaining principal of your loan. So it is an extra fee that FHA loans have. So whenever you start talking to a lender about buying a home, there's some different things that we begin to bring up. We talk about principal and interest, and then we also mention taxes and insurance. So, I'm sure that you're not strangers to taxes and insurance. But as they relate to homes, there's a little bit more information that the first-time home buyer, even the second-time home buyer, might not understand or realize. So That information is that you pay your taxes and insurance for your home on a monthly basis. So we add up the principal and interest, and then we tack on the taxes and insurance to your monthly payment, so that you're just paying one flat fee each month, and the principal and interest payments go to paying down your loan and paying your lender. The taxes and insurance get paid into an escrow account. And so the next question is, what's an escrow account? So escrow account means your lender has created an account with your name on it, specific to your property, that will pay for your taxes and your insurance when those bills come due. So here in Texas, we pay property taxes once a year, and property taxes are pretty expensive. If you buy a $300,000 house, your tax bill might be $9,000. So if that bill sneaks up on you in December and you've got to come up with an extra $9,000 to pay your tax bill, you might be a little bit surprised. So what your lender does is they collect that $9,000 over time, and they put it in this escrow account. And when the tax bill comes, your lender pays it out of the escrow account, so it doesn't hit you all at once. You've been paying that over time. And the same is true with your insurance. It gets put into the same escrow account, and when that insurance bill comes due, your lender pays it on your behalf. All right, so like I just mentioned, property taxes are quite high here in Texas. In El Paso, we have a tax rate that is over 3%. In Las Cruces, the tax rate is a little bit closer to 1%, just below. Next question is, what is a homestead exemption and why should I care? So here in Texas, if you're living in your home, that's considered your homestead, and you can apply and be granted an exemption on your taxes for a homestead exemption, which reduces your tax liability on that property. So homestead exemption saves you money, and that's why you should care. So these next questions are related more to what happens in the loan process. What is loan processing? So if you find yourself in the loan processing stage, congratulations, you're under contract to buy a home, and my team and I are processing your loan, meaning we are taking the information from the contract and taking your personal information, your income, your debt, your credit score, your loan type, and we are structuring the file to get it ready to present to an underwriter. So while that's happening, we are going to order an appraisal. So you might be asking, what is an appraisal used for? We use appraisals to determine the value of the property, and therefore the amount of money we can lend you on that property. So just because you are under contract to buy a house for $200,000 does not necessarily mean that in the eyes of an independent appraiser, that house is worth $200,000. So we hire somebody who's a third party, not involved in the purchase whatsoever, to give their independent opinion of value, and that is how we base our decision to lend money on that asset. So once we get the loan processed and we get the appraisal back, like I said, we want to present it to an underwriter. So you're probably wondering, what is underwriting? So underwriting is someone who goes through a list of checks and balances and makes sure that myself as the loan officer has set up your file correctly. So underwriters are the last step of the process before your loan can be approved and we can move into the funding stage. All right, so the funding process. Once you're approved by the underwriter, we can move on to funding your loan, and that's where we communicate and coordinate with title to finalize the transaction. That's where you as the buyer can sign the documents, where you take on this new loan and you sign the deed of trust that names you the owner of the property. And then that's also where the seller comes in and they sign over those documents to you and sign the rest of the documents that allow them to no longer own the property and get paid their funds. And so that all happens with a title company where they're handling the money, they disperse the money to the seller, to everybody else involved that is getting some kind of a payment, such as insurance, real estate agents, etc. So those are the 20 questions that I came up with to help educate folks going through the home buying process. Again, I want to be a resource for y'all. If you're in El Paso or Las Cruces and would like to meet face to face, I'm happy to do that. If you want to just give me a call or send me an email, that's cool too. But beyond those cities, I'm licensed for the entire state of Texas, all of New Mexico. I'm also licensed in Arizona, California, down to Florida, and in Virginia. So if you're looking to buy, sell, or refinance in one of those states, or if you've got friends or family members that might want to have a conversation with me, please let me know. I'm really passionate about helping people become homeowners and would love to be a good resource for y'all as you go through the process.